several years ago, we had the advent of the 506c fund, right? And that's a similar private placement offering. So these are, funds that are not publicly traded. They have very limited liquidity, and they're typically offered only to accredited investors. But now with a 506c, an investor can directly invest into the fund without going through a financial advisor or any sort of intermediary. So this allows a sponsor, like a fund sponsor, to advertise directly to a retail investor. And again, it's all relative. When I see retail investor, I'm talking about accredited investors. So, that's one part of the trend. I think is just simply the existence of 506Cs now, which has really been in the last decade or so. That has been one thing that has democratized the industry. But another thing is, we had David Swensen. So he really popularized this with the Yale Endowment Fund. And for years, the Yale Endowment Fund had much higher returns, than most endowments. He basically was pretty open about the strategy. And so over time, that strategy became more and more popular with endowments and institutional investors. And just any type of large investor like a pension fund or anything like that, they're more conservative, but if they see other folks in the space having success, they'll sort of slowly move into it. And what's happened is these institutional investors and, pension funds and endowments, they've sort of slowly adopted these illiquid alternative investments, and they've set more or less, each of them has set their own portfolio target where we want 20% of our portfolio or 30% of our overall endowment to be in alternative investments. And in many cases, they've now met that goal. They've met that threshold in their own portfolio. And so now it's more a matter of maintaining that ratio within their portfolio. But for the past 20 or 30 years, that was a huge tailwind for the whole industry, is that a lot of these institutional investors who manage tremendous amounts of money were starting from a pretty low level, and we're just trying to deploy more and more capital into these alternative investments. Now that a lot of those larger investors have more or less met their goal in terms of allocation, I think that the industry wants to turn towards a new source of growth, right? And so that new source of growth, by default, has to be the retail market. And again, I use that term relatively, the ultra high net worth, the very high net worth, and in some cases, sort of your quote unquote everyday accredited investor. But really, I think they're more targeting, folks with a net worth of 5 or 10 million or more.